Hi folks, in this topic I'll be talking about individual stock qualifier. In the previous video I did talk about market check index, which you must have seen, but again to come back to that conversation for a while, uh, as any investor, I mean if you are into trading with your own research, you can choose not to look into market at all. You can tell the algorithm that okay, I don't want to look into the market at all. But if you are little careful, you want to go with the market, then I have already explained how you look into the market index and how you identify what would be your no investment zone and so forth. But now going forward with individual stock qualifiers, what you do is you basically you are looking into a lagging indicator all the time. Say for example, you might be looking into moving average 2 versus moving average 10, or you could be looking into something like moving average 5 over moving average 20. It all depends on your research from your fact findings, what you do. So you can look into MA3 over say MA12. What it means is you're looking into the price movement for the closing price for last two bars versus the last 10 bars from the closing side of it, uh, from the closing price. Or you might be looking into last 5 bars on a daily chart versus last 20 bars. So you're taking an average of these two. I mean, you're computing that number. Say for example, I'll give you an example here. Say, let me copy this out and put it here. Just get some space. So you might see that, okay, on a MA2, you might be looking on any chart, any price. So I'll put a price here just for simplicity, and then I will probably take you also to a chart. Say MA2 is 20.1 for a price, or let me, to be more precise, let's pick up anything here. Let me then plot these two indicators. Say for example, I'm taking moving average, and I'm taking moving average of 2, and I want to keep it in green color, and I'm taking another indicator which is moving average of say 10, and I want to keep that in red color just to identify the two lines. So now you take a look at here. Now let's pick up any stock for simplicity purpose, say DHI as an example, and let's take a look at what is going on with DHI when it comes to those two numbers. So DHI is, if you notice, DHI price currently, as the market is still on, market is open, it is 52.25. But if you take a look at the green, which is moving average 2, and moving average, the red, which is moving average 10, it is moving average 2. You can read it from here. Moving average 2 is 52.33 and 53.04. So what is it? Is 52.33 and 52.04. So what it means is, let me recheck it. Uh, the green is 52.33 and 53.04. 53.04. So this is 53.04. So what it is this is the fast moving average, which is looking at 2 days versus the 10 days, or 2 candles versus the 10 candles. So you're basically looking at the faster one, which is at 52.33, and the slower one, which is the 10-day or 10 candle average, you're looking at 53. So this is below this. So if you take a difference of the two, say for example, you're going long and you're trying to take a difference of the two. So what you're doing is, so I'll put a percentage. So this minus this divided by the slow times 100 is a percentage which I'm getting as minus 1.35%. So what it means here, if you go back to the chart, you're seeing that this fast moving average is way below the slow moving average. As a result, the stock price is also going down. So this is nothing but these are the lagging indicators, but you are seeing that the difference is quite a lot. If you take a look at the Excel, the difference is over 1.35% on the negative side. So that shows that it is expected, if you're doing short, it is expected that the price will continue going down at this point of time because the differential is pretty high. So this is exactly the point I'm trying to make. Now it is the market is negative, so you will see most of the stocks going in the negative direction. So let's pick up another one, say DUK, and try to see what is going on with DUK. And you will notice that DUK is probably also, although it was doing well, but right now, as I'm doing the demonstration, it seems like it is going down. But the slow moving average is still way above the fast moving average. So that means it is still not giving a clear indication that it is going to go further south compared to the previous one. So if you plot the number, here, the fast, which is 83.85 and 83.72. So you see that 83, 85 and 83.72. You see the differential is still very positive. So the point I'm trying to make is that if you are going short, the previous case was pretty good, right? Previous case was pretty good. Say, for example, if I undo it, the previous case was minus 1.35. And if I take this particular chart, the tolerance is 0.15%. So the point here is you tell the algorithm that if you want to go short, you go anything where the tolerance is over minus 1% or minus 75%. So in the short direction, that means you're telling that the moving average you're looking at 20, the fast one at 2, the slow one at 10, and you're telling them that, okay, even only if it goes below minus 1.0, as I have shown you in the example, you consider that as a short. You can find out few more examples to see which ones would be going long. I'm assuming anything over 1% would be a good point for you to go long as an example. So having said that, this is at this point of time, this stock is still not taking a turn. So you cannot say that it's going to go south. Let's pick up another one. EA. Let's see EA, what is EA saying. I'm trying to give you some examples, but this is how you find out and fine tune the configurations which you need to put onto your algorithm. Say for example here also it seems like the market both the long, slow and fast is almost at the same place, so it's not still giving you a direction here at this point of time. So you can pick up one more stock, say DKNG, and you take a look at that. Here also you can notice that the differential of fast and slow is not as much, and here if you want this thing to go further north, the ideal situation would be that MA2 is higher than MA10 by 1%. So that means till this green line comes around here over the red, you cannot confirm that it is going to go in the north direction. So you can tell the algorithm what you want, how you want to configure it, how you want to set up the parameters. But this is the point I'm trying to make, that it's not only the market which you are checking, but also at the same time every 60 seconds you are looking into the movement of the moving average, fast and slow, to confirm that okay, you are going to go north or you're going to go south depending on that tolerance percentage which I just mentioned. So it depends again how conservative you want to be or how aggressive you want to be. You can even set it up for long positions, go anything over 0.5% on the differential, I will take it. Or on the short side, maybe you keep it as minus 0.75, I will take it for short considerations. So what you're trying to say is that into the fast and slow moving averages, and you're trying to tell the algorithm that if their differentials is over a certain percentage or below a certain percentage, go for long or go for shorts. So this is exactly what you're trying to do here. You're trying to figure out that if the direction of the stock is going to go north or is it going to go south, depending on the configuration which I just mentioned. So when you marry these two components, I'll take few more stocks just to show you if I can find something else. So let's say take EL because this is the right time to do this because the market is also in the moving condition at this point. You see here the point here which I'm making is first of all the market this particular stock is taking a U-turn from the green, but the moving average also is also taking a U-turn. So in this case you can tell the market that okay, if the market is over a certain percentage, if this differential is over a certain percentage, and there is one more configuration which you will also look at later on, that if the bars are not higher high, then do not consider this as a long. So we haven't come to that point yet, but I will come later on. So if you put all those three conditions together, which I just mentioned, I can see that this last 15-minute bar, which I'm looking at, is not in the higher high direction. So this is definitely not a sweet spot. So even if the market is qualifying, the stock will get rejected because the market, all this differential could be 1%. I don't know. Maybe it might qualify here. It did qualify on these two bar, but it did not qualify here. So you are blocking these type of investments. Why? Because you're not getting a sweet spot. So humans cannot do that, as I have just mentioned, and I have been telling this ever since I'm doing this video. Humans cannot do that, but every 60 seconds, the algorithm will probably look into all this scenario. Now, the question is whether you want to keep it at 15 minutes or you want to keep it at, say, 5 minutes would depend on the research what you're doing. You can try different techniques. You can try it on 5 minutes or you can try it on 15 minutes for that matter, or you can try it even on say 30 minutes. I'm not sure whether you'll get what you'll get on 30 minutes. It seems like it's going on the low direction. You'll get a rejection here. And because as soon as you plot the third criteria that the bars has to go higher high, this will disqualify. Even if this distance or the distance between MA2 and MA10 could be more than 1%. If you want to plot it, let's plot it here. It's 178.91 and 177.81. Let's put it there. 178.91 and this one was 177.81. See, if you would have put it at 0.5% on the tolerance, this would have qualified because it is at 0.61%. So you try to find out what will be your most optimum uh, threshold in order to let it qualify. I typically do it at 1%, but it's up to you. Again, I'm not going to enforce anything here. You can even put it at 0.75. This will disqualify. But that's one thing, but there's another component which you will look at, and that means this tolerance is going to disqualify. But even if it qualifies, there is another feature where you are trying to also look into if these bars are taking a higher high. If it's not, then reject this stock. So humans, as I said, in quantitative trading, this is possible, but humans cannot do that. It cannot look into 300 stocks or 200 stocks on your list every 60 seconds to figure out what are these scenarios and whether it should even take a position. So when you do your research, you can find out, say for example, you can take this stock. As you notice, when you do some historical tests on, say, 50 to 100 stocks, just to come up with some estimate, you will notice that as these moving averages go higher high, and if you would have been at this point, you are differentiating between these two lines. You are looking at the market condition, which is bull probably. Under those conditions, you are noticing that the price went from 173.74 if I'm looking at the closing price, and it is going here to a high of 175.96. So you had a pretty decent rally here. If you would have gone for swing trade, maybe you would have gone for the next day and continued rallying. But even if you would have done intraday, you would have made some decent money. So the point is, this is a little bit of a learning curve for you, but you will have to probably plot it in Excel to find out that, okay, what would be my threshold? And at that point, you can tell the algorithm here that, okay, if it is over 1% or 0.75% of the moving average, whichever you want to follow, whether you want to take MA202 versus MA10 or MA5 versus 20, MA3 versus 12, whatever it is, you can define your own criteria and figure out what would be the threshold for it to continue rallying. And this historical data, which I'm trying to show you, which happened in the past, is a very good example that the stock continued rallying with the market conditions, and it rallied for a while. Say, for example, if you're looking into yesterday, the market was very bull. Um, it took a pretty nice rally here. If you pick up any other stock and take a look at what happened, say FAST as an example, yesterday I think it was pretty good. FAST. So if I'm looking into yesterday's data, you see here, this is 518. It took a pretty good spike because the market was good. This differential is pretty good, and it took a rally. So whether you are looking at MA2 versus MA10, or you are looking into MA3 3 to 15 or 15 to 5 to 20, you find out which one would be your best combination and choose that and plot it into the algorithm for your mathematical for the algorithm to qualify that particular stock. So as a point of conclusion, there are two important things which you are looking here. One is the market, looking into the market condition, whether it is over investment zone. You're looking into the individual stock with lagging indicators like 2 to 10 or 5 to 20 or 3 to 12, and computing their tolerances as to over what tolerance you would probably take them for long or for short in the reverse direction. And there is one more which I'll cover, which I haven't, is to look into the last 5 minutes or 2 minute bar to make sure that those stocks which you have selected is taking also a higher market side. So when you combine all of these things together, inclusive from what I have started talking from the very first feature, you will notice that now we are having a pretty decent model for us to say that, hey, you know what, if these are the conditions which configure, and if these are the conditions which we configure, and having said that, if you run it on simulation and you see for next 15 days or 20 days you are getting very good result, at that point you just lock it and continue running this configuration without disturbing it. So having said that, if you have any further questions on this, you can ask me, but keep in mind that these numbers has to come in from little bit of a research which you do based on your strategy. Remember, strategy is very important. If you decide on the very start that I will do an intraday strategy, then throughout all the configurations which we are talking about, you have to think for an intraday type of a strategy. Remember, I was talking about stop losses, milking profits, everything is strategy driven. So you cannot mix the two. If you're looking into this and this moving average here with the individual stock qualifier, and you're looking into something different when it comes to say for example you're looking into entry point and exit point or stop loss or I mean milking profit criterias, keep keep in mind that they all has to be in sync with your strategy. Once you do that, you will be able to get to a sweet spot within a very short time. And once you get a sweet spot, you run it for a few days and then move to real time to generate passive income. But you don't have to change thereafter once you set all these things at a certain given point.